Hello and welcome to the weekly round of Mint Newsroom. I'm joined by three smart reporters over here to discuss about the various interesting things, corporate actions happened last week. And over last 10 days, there have been a lot of regulatory changes that will have a direct implication on corporate strategies. And some of the corporates also adopting smart strategies to put their neck out of the water during the slowing economy. I'm Madhura. Madhura, will you tell me what are the interesting things? How these corporates adopting smarter strategies to stay afloat?
So Sanjay, basically in the last 6 months, we've seen a lot of corporates selling off their assets and using the proceeds from those assets to pay off debt. So a recent example could be, IVRCL, the infrastructure company, who sold some land in Chennai so that they could serve the huge debt. Again, we had the JP Group, which is planning to, hive off some real estate assets and then again use that for servicing their debt. And what is happening is because of the slowdown, there's a lot of liquidity crunch in the market and also margins are under pressure. So most of these interest coverage ratios for most of the companies are really low, which is not a good indication because a low interest coverage ratio is an indication that the company is really uncertain of covering its interest with the cash flows that it's generating. So asset sales is something which really a lot of corporates are, applying for reducing the debt.
Thank you. She's right. Initially these infrastructure companies were a bit reluctant to sell their assets because of citing valuation. But Malvika Joshi, will you tell me what are the doing in terms of listing their companies in the other economies, as well as what are the regulatory changes which is happening right now?
Sure. Sanjay, you know that IPO market in our country right now is almost dead. So what SEBI has done is it is now allowing companies to go ahead overseas and list directly, which was not the case earlier. Also earlier the norm was that if Indian company has to go overseas and get itself listed, it first had to list itself in the country. Now what this change in regulation will mean is that there's not enough investor appetite in the country right now for IPOs, even good IPOs. So companies can easily go ahead and raise money overseas, and if US money is flowing in, it's all the more better. Second thing is from the bankers, what I'm getting a view is that not like the companies which will be going overseas for listing will not be small or medium sized companies. It will be unlisted companies of large corporates which are already well known. So I think it will really the move is more in favor of big corporates which are well known.
Thank you. That's a great point where, one of the units of L&T as well as IL&FS Group are also mulling this kind of IPO in Singapore. When we talk about Singapore, Aveek, you did a critical story on the change in regulations regarding IPO and as well as mergers and acquisition. Could you tell us what is the kind of implication this would have, the regulatory regime change would have cost to the companies?
So there have been two very important regulatory developments over the last 10 days or so. One has been the fact that SEBI has now allowed companies to sell shares through put and call options. This has been an issue of much contention because a lot of companies had gotten into deals wherein they had a put and call option to sell shares or buy shares at a later date at a certain price. But SEBI so far had held the view that these are probably not in accordance with the guidelines. So a lot of these deals were stuck, especially at a time when there was not too much of M&A activity happening in the economy. But now that SEBI has cleared the path for these deals to go through, hopefully we will see much more deal-making activity. The second thing that has happened is that the New Companies Act has come into being, and the SEBI, the stock market regulator SEBI, has decided to tweak its own guidelines in order to align it with what the Companies Act says, because right now there are some gaps between what the two sets of regulations says. For example, the Companies Act says that if the promoter of a company is its executive chairman, then 1/3 of the board, at least half the board, has to be independent. But now the New Companies Act says that only 1/3 of the board needs to be independent in such a case. So there is a discrepancy which SEBI is working towards settling. The other thing is that the Companies Act has given SEBI some responsibility to decide certain things. For example, the New Companies Act says that if in a share purchase, in an issue, in a public issue, a certain amount of shares is not subscribed, then the issue will be considered to have not gone through. But it has not said what is the quantum of this subscription, and which SEBI will have to decide. So I think these are two developments which will have far-reaching implications for the corporate sector.
Thank you, Aveek. So there's a new Company Act, and the capital market regulator is aligning itself to the new rules, and the economy is slowing, and companies are trying to stay leaner and much better. For more actions, please log on to livemint.com.